Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Wednesday, June 29th at 10 a.m. in New York. Washington, D.C. continues to focus on two areas of bipartisan concern: fighting inflation and managing the economic relationship with China. To that end, deliberations continue on legislation intended to reduce reliance on China's supply chains for semiconductors and rare earths materials, as well as invest in research and development for emerging technologies. The Senate and House have both passed versions of this legislation, respectively called the USICA and the Competes Act. Now there's a conference committee deciding what's in the final bill. And here's where investors need to pay attention, because there continues to be news that this committee could end up including a provision that would limit U.S. companies' ability to make business investments in quote-unquote countries of concern. If they do, it could create downside pressure for markets in China in the near term and would underscore the secular trend we continue to focus on, globalization, which creates both equity sector challenges and opportunities. Consider that these outbound investment restrictions would mirror ones already in place for inbound investments through CFIUS, the Committee on Foreign Investment in the United States. In short, it could make it difficult for companies to, say, build a factory in China if the product or production process includes technology that the U.S. deems critical to its economic or national security. Some independent estimates suggest this could reduce foreign direct investment in China by as much as 40%. This is classic globalization in motion, where policy choices are cutting against the cost benefits of globalization, driven by security concerns as we move toward a multipolar world, one with more than one political economy power base. And the level of disruption from this particular provision could create downward pressure on equity markets in China. It could also underscore current headwinds to U.S. markets, suggesting that many U.S. companies' margins will be pressured as they spend more in the future to diversify supply chains away from China. Of course, in line with our thesis of globalization, there's opportunity too. The capex needed to build these new supply chains has to go somewhere. And for example, semiconductor capital equipment companies could see a major upshift in demand. So investors need to stay tuned to the deliberations on outbound investment restrictions. It's far from a done deal, to be clear, but a major policy development if it happens. While there's no timeline for when we will know if this provision is included, we recommend paying attention to the Biden administration's deliberations on China tariffs. If the administration decides to provide even just targeted and temporary tariff reductions in an attempt to ease inflation pressures over the next couple months, it might also feel compelled to, at the same time, announce new measures to demonstrate its continued seriousness about competing with China. An announcement of a legislative agreement on outbound investment restrictions could be one way to do this. Thanks for listening. If you enjoy the show, please share thoughts in the market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.